Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show, and we're filming it actually on Thursday, so we get to pick up, essentially everything that happened yesterday with the Fed. What does it mean? So we're going to really talk about, how are things changing going forward, and the way we're going to break it down. In the first segment, we're just going to do global growth. Nothing surprising there in terms of the issues that are persisting throughout the supply chain. We're just going to do a brief update on that. That should be a pretty short segment. Then the next segment is going to be, what does the Fed do next and why? And that's, I think, the biggest thing of what are they going to do next? How is this going to happen? Because I think there's a lot of conflicting data points out there in terms of how is the Fed going to respond to this inflation, which inflation metrics matters most. And I think those are some of the key things that we really want to touch on in that and look at some of those leading indicators. Then we're going to wrap up with retail sales. They missed estimates. This is what we were expecting for November. And we want to look at what does that mean as we go into the rest of into next year. Then we're going to look at emerging market in Europe, European pressure. So there's a lot of problems that we're seeing in terms of the emerging market side, and it's hitting some of Europe a bit where there's just some data points, but nothing too crazy. And then we're going to wrap up with China data misses. Again, not surprising. And then some of the other India, South Korea, and Japan, and some of those different data points. So hopefully these will be a little bit shorter shows as we get towards the end of the year, and then and next week will be our last set of shows for the year. So we are getting close to wrapping it up after another successful year of trying to grow subscribers and hopefully helping you understand things that are happening in this crazy market, crazy world at this point. I don't know about you guys, but I know that when I drive to work now, all of the testing centers are just lines around the corner. Everybody's panicked and trying to get tested as quickly as possible in terms of just the spread, but also ahead of the holidays. So it's going to be a very interesting time over the next couple weeks. So now just looking at a brief overview of some of the global manufacturing, because I think that's really the biggest piece that we like to look at to understand what is going to happen as we go into next year. And this is a big one where when you look at output and new orders, and new orders keep coming lower as the output also is coming down, but the new orders is really that leading indicator. And it's a mixture of, there's backlogs, so that's a piece of it, but there's also, when you look at those material shortages. So the material shortages, and this is the share of manufacturing firms citing shortages of material and equipment in the UK, Eurozone, Australia, Canada. Again, it doesn't matter where you are. There's massive shortages. And the US is actually getting a little bit better, where our shortage isn't as bad as it was. The delays and supply chain has gotten a touch better. But again, when you zoom out, we're just better than the worst it's ever been. So you're still getting some of those conflicts, but the U.S. was really ahead of that, where a lot of these other countries are now starting to see, reaching the same level of problems we have, which is, again, slowing down output, and increasing backlog, which then is decreasing new orders as people are waiting for that backlog to come through. And this is going to impact, again, that full supply chain, beginning and ending with the emerging markets, which we believe is still going to be the struggle point, and we're going to talk about that more in segment 4. Now, when we look back, and the IMF has put out this the breakdown of debt. So in 2020, global debt experienced the largest surge in 50 years. Again, not surprising. I think it's just interesting to see it on just as well kind of displayed and pretty, if you will. And it was across the board. It was private debt as well. It was public debt, obviously. And now we've seen that start to slow down, but you still have to pay it off. You still have to roll it. And as we have rates creeping higher due to the rate rising cycle, due to the pressures around the world, again, that's just going to make it more expensive. And as you can see from this chart from 1970 onwards, we've never really had a meaningful step down in debt. So now we had this huge surge, but most of these balance sheets globally are still in a deficit, which means that the debt's still going to grow, which means you still have to roll it. And that's where we see a lot of these pressure points. And this is when we start talking about fiscal drag, monetary drag. And it's really because you had this huge shot in the arm. People got this money. They did what they could with it. They tried to. And then a lot of this was pulled forward a bit in terms of spending, in terms of investments. And now you start to get this drag as there's more austerity. There's a little bit, a little bit of a slowdown in terms of just stimulus that has come through, trying to, again, normalize some of that backdrop. And the other thing is you have to consider, where does a lot of this begin? Is it a chicken and the egg type situation? But you have to look at the OECD nations, the developed nations, who are the biggest buyers. And they're the ones that, as their buying slows, as they peak on a growth level, that reverberates through the system, because they're going to need a little bit less raw materials. They're going to need a little bit less supply chain equipment, things within that again, is going to create that drag on the emerging markets and that underlying pressure. And we're already seeing a lot of that start to roll over, again, as we've been saying. And it's not that we see this huge, massive recession that's going to create this massive drag and we're going to be in a dire straits. It's just global growth is slowing. There's estimates out there that have started to finally come down. And we're starting to see that normalize, which is when you look at the economic surprise indexes from Citibank, from Citi. So you're seeing that United States, things are positive again, Eurozone, Asia Pacific. So you're starting to get estimates coming down, but a lot of the estimates have been fairly strong, or, bouncing, if you will, going into 2022. And as for those that have been watching, I think those are incorrect. I think, as we were saying in Q2, Q3 of this year, that everybody was too high, too aggressive, and they were going to have to take down estimates. We've gotten that. Now we've gotten the estimates coming further in line. Some of the data is coming in a bit better than expected, and you're starting to see this level off. But our concern is that now things are bouncing a little too much in terms of where the view of 2022 is. And we still see a lot of risk and problems as we go into next year. So, and the other interesting thing, and this is one that is important when you consider what does GDP growth look like? And this is looking at capital formation, gross fixed capital formation, which is just, again, capital expenditures in some large economies. And the U.S. has been fairly stable. And it's really because companies have shifted how they're investing. They're investing more in technology, IP. And we have some slides looking at, how is working from home being adopted? How is that going to shape things going forward? Where South Korea, Germany, Japan have seen a fairly strong drop. And we haven't seen too much of a reversal. And just given some of the underlying data points, we don't see that reversing higher anytime soon. We don't see it going much lower, just to be clear. It's just we don't see this huge surge back up like we did in the U.S., where we had this strong bounce off of Q2 of 2020. And then we really kind of peaked out and have remained elevated. Instead, we've had some of these spits and starts in Japan, Germany, South Korea, and we see a lot of that pressure continuing, especially in Germany and Japan. But Germany is the one that, again, as we've been talking about in our European section, that has been the point of the most concern, because they are obviously an exporting nation, a big driver of European growth, and they've hit a lot of snags with the most recent PMI coming out actually below 50 for the service side. So still those issues on the retail sector, which continues to be a pressure point as we go into next year. But then when we look at home prices, and you look at the rising home prices are a function of rent price growth and declining rental yields. So rental prices continue to go back up. We've had a big recovery in a lot of them at this point in time, especially in the US and in a lot of other areas, which is also increasing the rate of inflation. That's increasing the cost of living. And as wages are not able to keep up, this is where we see a lot of that pressure when you're looking at what is the consumer going to do. We've seen savings starting to normalize as wage growth doesn't keep up, as costs continue to rise, which again, as rents rebound and then go well above, given the central bank activities, the increase in asset prices, that has increased the underlying pressure and realistically is going to keep a floor beneath that inflation side. And that's where, this is where you get tailwinds, headwinds, what is inflationary, what is deflationary. And depending on which one that month is going to be the driver, that's where we're going to see more of that stagflation giving way, because there's going to be enough of those tailwinds to really keep us elevated. But some of the other components, especially on the flexible side, starting to come down, that's going to keep us again into that stagflationary standpoint as we progress into Q2 and Q3 of next year. So, and this is one of the ones that is, just looking at some of the pricing. So, sea freight rates, not only ones, are not the only ones to surge throughout the pandemic, as air freight rates have also soared to record. And it's because we've lost a lot of commercial flights. So about 40% of commercial flights and the luggage that's in the belly of the plane is actually air freight, not people's luggage that is on the plane. So when you lose a lot of those flights, then now you have everything going on to air freight because you're trying to get things as quickly as possible. And that has kept this massive bid behind the amount of cost. And as you can see here, it really hasn't dipped down, and we don't see it falling just because you have jet fuel prices that have gone up. You have the cost of shipping has remained elevated, but also there's just more people that need things as quickly as possible and are willing to pay top dollar because air freight is obviously going to be faster versus what is happening at sea. Then when you look at what's happening at sea, the lead times are up again in November. And this is where when you look at chips, so this is looking at microchips and just how the delay continues to get worse. You can see that the rate of change has gotten better, but we're still not at any point in time of seeing this reverse lower. And as we were saying in Q1 and Q2 of this year, people said we were crazy. Everyone was like, oh, things will be perfectly fine by December. And our view was it's not going to be until at least Q2 or Q3 of next year, but most likely it will progress even through next year, keeping that pressure on point and keeping a lot of those issues alive, which again is where we see, and that's going to be a reverberating problem. And it's another interesting piece and we'll talk about this in segment 5 when we're looking at South Korea and just export prices, because this is a big piece of Samsung and other pieces that are going into technological goods. What do the technological goods look like? What is the cost of them? And this is a big piece of it when you look at the underlying input cost, and chips is a huge piece of it. And that's why we think that there's going to be a lot of pressure as we go into into next year, which will continue because we're also used to technology always getting cheaper. And it's where we've come to a point where that has really started to reverse. And here's just looking at the freight benchmark. There was a slight tick up from Shanghai to Los Angeles. But again, it's off the highs, but still when you zoom out, looking through 2018, you can still see that it's still exponentially higher. And then when you look at container ship wait time, it's almost at 21 days on average. It's flat line for the most part, but still you can see just when you look back through time, just how long that really is. And then when you factor in the wait time at sea, the wait time to get on a truck or a train, and then the delays getting through, you can see just how difficult that has become around the U.S. And then this is just, again, shifting to the U.S. for a moment. When do you expect supply chain disruptions to end for your business? And you can see that a lot of this really doesn't stop until really the end of Q4. And those are some of the things that continue to get worse in terms of where some of these shifts are. And we think that as this progresses through Q1, on the back of new shortfalls caused by China, as we've had another increase in COVID cases in China, which has shut down some regions, or I should say not just some regions, but some ports. This will continue to slip that to the right. And now rounding it out in terms of just what is happening in the U.S. right now, U.S. equities are outrunning relative earnings. I don't think that's surprising as multiples continue to get bigger. But as yields go up, rates go up, I think you're going to start to see this converge a bit as we start to get some of that margin compression coming back out. But now that we've gone through kind of the global backdrop, we really want to shift and look at what did the Fed do yesterday and what does that mean as we progress really all the way through 2022 and into 2023.